Schiff, U.S. Treasuries are a lousy deal. Are U.S. Treasuries a good investment right now? Not if you consider the rising inflation rate. In fact, in his most recent podcast, Schiff called U.S. Treasuries a lousy deal. Producer prices, PPI, came in unchanged in July, but year over year, we had a 3.3% increase in wholesale prices. PPI serves as a leading indicator for consumer prices, so you can probably expect the prices you're paying at the store to continue to go up. According to the government, consumer prices are already increasing at a 2.9% annual clip. Peter said, it's just a matter of time before the consumer price index pushes past the 3% threshold. We're almost at 3%. The only question is how much longer will the CPI have a 2 handle before it has a 3 handle. The PPI already has the 3 handle on it, so it won't be long before the CPI has the 3 handle. In fact, I think we're going to move from a 3 handle to a 4 handle much quicker than we moved from a 2 handle to a 3 handle. Meanwhile, the dollar remains strong. In the Schiff Gold Friday gold wrap last week, Mike Maharrey noted that gold has not gotten the safe haven bump you would expect despite a lot of global turmoil right now, because a lot of the safe haven bid is going into the dollar. It's not only the dollar that's benefiting. The currency turmoil in a number of emerging markets and the budding crisis in Turkey is boosting U.S. Treasuries. Yields on the 10-year have dipped back below 3%, hovering in the 2.85% neighborhood last week. Peter said, a 3% 10-year Treasury is actually a lousy deal when you factor in inflation. If consumer prices are rising at 2.9% per year, and of course, that's just what the government claims. I mean, obviously, if the government is admitting that prices are rising 2.9%, they're obviously rising much more than that. Right? Because the government is lowballing the estimate of CPI. But let's just take it at face value. Let's assume the government is right and consumer prices are rising at just 2.9% per year. Well, if the government is borrowing money and giving you 2.85% per year, what does that mean? It means in real terms, you are losing money because the interest that you're getting doesn't even equal the annual depreciation of the domestic purchasing power of the dollar. So, you loan the government money and you don't get the money back for 10 years, but the little bit of money they give you every year does not even offset the amount of purchasing power you lose. Simply put, the money you get back in 10 years is worth less than the money you loaned the government. And consider this, the CPI isn't fixed, but your coupon is. When you purchase a 10-year Treasury, you're locking yourself into that 2.85% interest rate for 10 years. But the inflation rate is not locked in. And if you look at the trajectory, the trend of consumer prices, and you understand what's powering that trend, the rate is likely to continue to rise during the entirety of that 10 years. And so, the real yields are going to get even lower as inflation moves higher, and higher, and higher. On top of that, income from Treasuries is taxable. Peter did the math and determined that the real, after-tax yield on a 10-year Treasury comes to minus 1.2%. That's not a good deal. Maybe all of the people counting on the dollar and U.S. Treasuries as their safe haven instead of gold should rethink that strategy. Peter goes on in the podcast to talk about the growing crisis. He said the real Turkey is America. Give it a listen. Schiff talks yield curves, inflation and the looming recession. Last month, we reported that the global yield curve inverted, signaling the possibility of a looming recession. While narrowing to levels not seen since right before the 2008 financial crisis, the yield curve has not inverted in the U.S. In his most recent podcast, Schiff said he doesn't think it's going to happen. He said we may even see a steepening yield curve in the coming months. But this is not because there's not going to be a recession. In general, investors demand a higher rate of return for locking their money up in long-term bonds, and yield curves normally slope upward. The rate of return on a 2-year bond will typically be less than the return on a 10-year bond. During economic expansions, inflation expectations tend to rise. As a result, investors demand even higher yields for long-term bonds. To offset this effect, a sharply upward sloping yield curve generally means investors have optimistic expectations for the future. But during recessions, inflation expectations tend to fall. That puts downward pressure on long-term yields. The difference between long-term and short-term yields flattens and eventually inverts. Yield curve inversions have signaled all 9 recessions since 1955. But Peter doesn't think the curve will invert before the next downturn because the dynamics in the economy are different. In fact, he thinks long-term interest rates will actually rise and the yield curve will steepen as we go into recession. Typically in a recession, or at least the post-war experience in these boom and bust cycles that the central bank has created, normally, they are well further in advance in their tightening cycle at this point in an expansion. Do you know, we are already 30% larger than average, or longer than the average expansion. We're less than a year from this being technically the largest expansion in history. Yet the Fed has only managed to raise interest rates to 2%. Normally at this point, we'd be well north of 5%, and so it's a lot easier to invert the yield curve when you've got short-term yields up above 5%. And normally, the Fed is trying to fight off inflation, and that's one of the reasons that it's raising rates. And it is the fact that the Fed is making money more expensive, and we're deeper into the cycle, that the long end actually starts to fall, anticipating the recession that is going to result from the tighter monetary policy. And so that's what ends up inverting the yield curve. It's not that the inversion of the yield curve causes the recession. It's just that long rates start to fall as investors start to look beyond the expansion to the next recession, and they start pricing in the next round of rate cuts. As Peter pointed out, the flattening or inversion of the yield curve is merely a signal. You don't have to have an inverted yield curve to have a recession. Peter said, that's how it will play out this time. We will have a recession without an inversion of the yield curve, given how little headway the Fed was able to make in normalizing rates during the expansion. This time we're not going to get an inversion of the yield curve, and in fact, I think the long end is going to be rising because of higher inflation, and because of waning demand for U.S. Treasuries in the face of exploding supply, especially when we move into recession. This dovetails with a question we asked earlier this year: who is going to buy all of the U.S. government's debt? The U.S. Treasury Department plans to auction off around $1.4 trillion in treasuries this year. And it won't end there. The department expects that pace of borrowing to continue over the next several years. As Pete pointed out, the deficit is already in the stratosphere even without a recession. I think, as the economy relapses into recession, and the Fed has to go back to quantitative easing, the budget deficits are going to completely explode, and there's not going to be demand globally for those dollars. That would likely mean falling bond prices, and rising yields, i.e., interest rates. Not good news in an economy built on debt. As a result of all this, Peter thinks the long end will rise even as the Fed suppresses short-term rates. So what that means is that this yield curve, rather than inverting, is actually going to get steeper and steeper. Peter said, some people might interpret the steepening curve to signal that there isn't going to be a recession. He said that would be a big mistake. Peter also touched on this notion that rising interest rates are good for the dollar and bad for gold. That is not true, especially if you look at the reason that rates are rising. And it's not short-term rates that are rising. It's long-term rates that are rising. And they're rising because of higher inflationary premiums being built into the bond market, and because of supply and demand. Too much supply and not enough demand. All of this is bearish for the U.S. economy, which relies on a constant flow of cheap money. So, you make that cheap money less cheap, that is going to undermine the U.S. economy, and more inflation is bad for the dollar by definition, because the dollar is losing purchasing power, and if your currency is losing purchasing power, it is less valuable. You are less likely to hold the currency if it is losing value. And of course, higher inflation is bullish for gold because gold is an inflation hedge. Peter Schiff, out of the frying pan and into the fire. Turkey has been in the headlines over the last few weeks, as a currency crisis has rocked that country. But as Peter Schiff pointed out in his most recent podcast, all of the things commentators are frying Turkey over are happening in the U.S. as well. All of the criticism that is being leveled against Turkey, that their deficits are too big, that they have a current account deficit, they're keeping interest rates artificially low, they're keeping interest rates below the rate of inflation. All of that criticism can be applied to the United States. As Peter put it, America is the real Turkey. All the people who are willing to skewer Turkey because it's doing exactly what the United States is doing, yet they don't recognize the same problems that are building in the U.S. And America's creditors don't seem to realize it either. The irony of it is people who are worried about large deficits, unsustainable current account deficits, and interest rates being artificially low and stoking runaway inflation. The people who are worried about those things and who are selling lira are buying US dollars. Well, that is jumping out of the frying pan into the fire, because whatever people are worried about happening in Turkey, it's going to happen in spades in the United States. So, if people are worried about the lira, what should they be buying? They should be buying gold. And that's the one thing they're not buying. Gold made a new low yesterday. We plunged about $17, $18, back below $1,200 per ounce. Peter said, one of the reasons the gold market is being sold off is that the shorts are pressing their bets. They are being emboldened by the fact that we're in the midst of a crisis in Turkey. That should be good for gold. Gold isn't getting the safe haven bid. The dollar is. Since gold is not rising on events that would normally drive it up, well, that must mean it's going to keep going down. So, they're not buying gold, they're buying dollars. The question is, when will they realize what they are doing? When will they connect the dots to understand the similarities between the United States and Turkey, and the fact that we are ultimately in an even worse position, an even more vulnerable position? Peter said, Turkey could solve its problems by cutting government and allowing interest rates to rise. It would likely cause a recession, but the country could manage it. The U.S., on the other hand, is too far down the road. He said we shouldn't be worried about an emerging market crisis. We should be worried about a dollar crisis and a U.S. sovereign debt crisis. That's what's coming down the road. Peter went on to explain the dangers of populism and how it is driving events in both Turkey and the U.S. Make sure you listen to the whole podcast.